Welcome everybody to Stock Talk with Nico Criticos. Today we're going to be doing some stock analysis on Goodrx, ticker Gdrx. This was requested by somebody from one of my other YouTube videos. And so what this company does is, as you can see here, they are a consumer-focused digital healthcare platform. And what they really do is they help consumers compare prices for different prescription drugs from multiple different pharmacies or retailers. So this stock has now been down over 78%, and last year it peaked out at about $47 a share, and today it's only $8 a share. So this stock is a $3.2 billion market cap, and we are going to use Nico's stock market checklist to do some analysis. So as you can see here, same thing of what I said, and the way they make money is through taking a cut from the pharmacy, which is a referral fee. And they also make money by using ads on their platform. So from the research I've done, I've also read that they are working with over 60,000 pharmacies across the country. I've never personally used this service, but it seems like they have lots of customers and they're making lots of money and people are happy with their service. But the first thing on this checklist is going to be, is the stock down or oversold? And I put yes, because it's down over 75%. The next things are going to be revenue and net income. Revenue has been increasing. Last year, they did $745 million, which was an increase of 35%. Net income, on the other hand, I gave a no, because if we look over here, we can see that the net income has not been very steady. So net income has been, they were positive in 2018 and 2019, but then in 2020 and 2021, it's been negative. So not a great sign there. Then we have a healthy forward price to sales, which I measure by historical numbers, as well as is the revenue growth percent at least 3 times the price to sales. And I'm going to give this a yes, because it trades at a forward price to sales of 4 with about 16% revenue average growth. And it is much cheaper than the 10 to 25 price to sales range it traded at in the past. And this was over the past 2 years. So like if we go to the last 2 years of their price to sales, we can see that it's been 10, 19, all the way up to 25, and today it's only a 4. So if you are interested in buying the stock, this is probably the best time to start buying some shares. Then a healthy price to earnings, I give a yes. It's a 27, which is also much cheaper than the range of 47 to 111 it's traded at in the past 2 years. And this is a company that grows or is expected to grow revenue about 37% in 2023, which is also a very strong number. Then we get to, are they innovative? Do they have a moat? I gave this one a yes, definitely, because this is a newer type of business model. In the past, there has not been any, there's not been a popular service out there that does what they do by comparing different prices of pharmacy drugs. So I definitely would consider that innovative. As far as a moat, I think the more partnerships they can get with the pharmacies, that's a big moat. And just the number of customers, their reputation, that is going to be what they're known for. That's going to be what their moat is. So I definitely would give that a check. Is it a growing industry? Yes. Pharmacy drugs are definitely going to be here to, a popular thing in the future. And especially with a lot of the baby boomers now retiring, and for the next, 10 years or whatever it's going to be, many of them are going to, that whole generation is going to be needing pharmacy drugs. And so that's going to add to it as well. Then we have return on invested capital. This number is it says, where did I see that at then? Oh, that's why I gave it a no. I gave it a no because it was negative. They didn't make any money. Healthy margins, I also gave a no because their final profit margin was negative, but their gross margin is 93%, which is incredibly, incredibly high. And in the, before the pandemic, they had profitable years. So I'm sure they'll come back to profitability eventually. Healthy free cash flow, I'm going to give this one a yes. If we take a look at the cash flow statement, we can see operating cash flow has continuously increased from 45 million to 178 million. Trailing 12 months is 163 million, and they've invested, all the way up to $200 million, which is a little bit more than what they earned. But, and some of that, and then they also, looks like what? So 83 million went to issuing stock. Okay, and then end cash position is still strong. 845 million is a huge cash position, and free cash flow is continuously growing. That looks good to me. And then we have diverse revenue streams. I put yes because this one I was almost going to give a no, but I gave a yes because if they're working with 60,000 pharmacies, that's a big deal. And if they have tons of customers, then that means that even if they lose some customers here and there, they can still move on. And so that's the plus side. However, they are, I mean, if you look at it from the perspective of the only two ways they make money is a cut from the pharmacy and ad revenue, those are, it's not, you know, a super diverse line of revenue streams, but at the same time, those are two big enough revenue streams where you could make a successful business off of that for the long term. Then we have the balance sheet. So they do have more assets and liabilities. And if we want to look at their price to book relative to equity growth, we can see that this is a balance sheet that was at over a negative $1 billion back in 2019, and they managed to bring that all the way up to 800 million now. And so the past year, the equity has gone down a little bit, but year over year it's been increasing, and a price to book of 4 is super cheap compared to where it's been at in the past, which is definitely good. And their equity is 24% of the market cap, which is also very good. And then they do have a strong share buyback with $250 million of a repurchasing program happening in 2022. Then we get to our insiders interested. If we look at the chart for this, we can see that it's not a lot. I'll pull up the chart. There was not a lot. So that's what's kind of, I mean, I think a lot of people out there, investors and executives and stuff, maybe they're just they don't feel safe in the current state of the economy to invest. So that could be it. But still, with this stock down 80%, you would think there'd be some insiders picking up shares. So that they bought a little bit at 26 and 19, but how come they haven't been buying when it's $8? So that's a little bit weird. But we also have the fact that their founders are their current CEOs, which is good. So that's going to get a check. And then lastly, we have, does their cash balance cover 1 year of expenses? And yes, they have 845 million in cash, and 1 year of expenses for this company is roughly 700 million. So that's going to get a check. And all in all, we have a score of 15 out of 18, which would be considered a buy on my checklist. So am I considering buying some shares? Not really. I don't think it's a bad investment, but I think that there's dozens of other companies and business models out there that are trading at just as cheap valuations, and I'm going to invest in those instead. But I can't say this would be a bad investment. So thank you for watching. I will see you next time on Stock Talk with Nico Kritikos. And if you have any stocks you want me to review, comment down below, and I will get back to you. Thank you.